Welcome to this deep dive. This is the second and final part about REIT quantitative values for Alpha Integrated REIT, traded under the ticker M1GU. So let's just start right in on the income statement, looking specifically at the gross revenue and net property income performance for the first half of 2026.
Okay, the gross revenue for the first half of 2026 was recorded at exactly 62.4 million Singapore dollars.
Right, and if we compare this to the gross revenue recorded in the first half of 2025, which was 59.341 million Singapore dollars.
We see a 5.2% increase in top-line gross revenue.
Got it. And following this, the net property income for the first half of 2026 was exactly 37.157 million Singapore dollars.
Right, and we abbreviate net property income as NPI.
Yes, NPI. And the NPI for the previous first half of 2025 was 33.533 million Singapore dollars.
Which yields a 10.8% increase in net property income.
Right. Furthermore, the net property income margin was 56.5% in the first half of 2025, and it increased to 59.5% in the first half of 2026.
So that is an exact increase of 3.0 percentage points.
Exactly. The earnings per unit, which we abbreviate as EPU, for the first half of 2025 was 0.98 cents.
Right.
Earnings per unit for the first half of 2026 was 2.07 cents.
Wow, okay. That yields a 111% increase in earnings per unit.
Yeah, it's huge. So we have established that operating leverage expanded the net property income, and a 13.4% reduction in net finance costs cascaded down the income statement to produce a disproportionately large 30.9% increase in net income. And the source data explicitly states that in the previous 2025 periods, the management retained a portion of the distributable income rather than paying it all to unit holders.
Yes, exactly.
Right.
But for the first half of 2026, the distribution was fully paid out with zero retention.
Oh, wow.
So therefore, the 111% increase in earnings per unit is the mathematical result of two combined variables. The first variable is the 30.9% increase in total underlying net income. The second variable is the administrative decision to increase the payout ratio to 100% of available distributable earnings, abandoning the previous income retention policies.
Right. So when you multiply a larger cash pool by a larger payout percentage, you generate the 111% numerical increase at the per unit level.
Exactly.
Yeah.
And the net asset value per unit is mathematically flat in the Court of Dealers.
Right.
This net asset value per unit is mathematically flat when compared against the December 2025 calculation, but it represents a 6.0% numerical increase when compared versus the June 2025 calculation, which was 0.50 Singapore dollars.
Yes, that is correct. And moving to the trailing returns, the trailing 12-month distribution per unit is 3.86 cents.
Okay, so that figure is determined by adding the first half 2026 distribution of 2.03 cents and the second half 2025 distribution of 1.83 cents, right?
Exactly. And this 3.86 cents total represents a 19.4% year-over-year increase.
Finally, the distribution yield is calculated at exactly 8.04%. This percentage is derived by dividing the 3.86 cents trailing 12-month distribution by the closing unit price of 0.480 Singapore dollars recorded on June 30, 2026.
I am going to go to the next slide.
We proceed to the gearing, interest coverage, and debt costs. The gearing ratio is currently calculated at 34.9%.
And that is a numerical reduction from the 35.8% recorded in December 2025.
Yes. Subtracting the current 34.9% ratio from the 50% maximum limit indicates the entity has an available debt capacity of exactly 147.6 million Singapore dollars before breaching the regulation.
Okay, moving to income safety. The interest coverage ratio is 4.2 times. This is an increase from the 3.6 times ratio recorded in December 2025.
Correct. The interest coverage ratio is computed by dividing earnings before interest, tax, depreciation, and amortization by the total interest expense incurred over the same period.
Right, and the regulatory covenant floor requirement for this ratio is 2.5 times.
Yes. Furthermore, the asset security data indicates 100% of the assets are unencumbered. This means there are zero secured mortgages registered directly against the physical properties.
Okay, so there is only a negative pledge in place.
Exactly. A negative pledge is a specific contractual agreement explicitly forbidding the entity from using the assets as collateral for any other borrowing agreements.
Right. Well, we transition to the borrowing costs and the interest rate structure. The cost of debt is exactly 3.76%.
Which is a mathematical reduction from the 4.13% recorded in December 2025.
Yes. And the fixed-rate debt portion is 57.5%. This represents an increase from the 55.7% recorded in December 2025.
However, this 57.5% fixed proportion remains below the 70% tier that institutional metrics typically denote as a high protection threshold.
Got it.
Now, regarding the decrease in the overall cost of debt from 4.13% to 3.76%, this decrease is achieved through the mechanical calculation of the weighted average cost of debt, which operates entirely independently of the fixed-to-floating interest rate ratio.
Right. Therefore, replacing higher-cost historical debt with lower-cost current debt mathematically reduces the overall weighted average cost of debt to 3.76%, even if the proportion of fixed versus floating debt remains statistically constant at 57.5%.
Exactly. Floating rates adjust continuously based on prevailing central bank monetary policy. The specific macroeconomic condition noted in the source text is that the United States Federal Reserve released a statement in June 2026 signaling a statistical probability of a rate hike rather than a rate cut.
Okay, so therefore, the numerical interest expense applied to the 42.5% floating rate debt portion will adjust upward mathematically if the Federal Reserve executes that rate hike, which will directly increase future numerical finance costs.
Correct.
I'm going to go to the next slide.
We will examine the debt maturity profiles and the solvency sensitivities. The total debt is exactly 339.0 million Singapore dollars.
Right, which is a structural reduction from the prior total of 350.0 million Singapore dollars.
Exactly. Looking at the maturity timeline, there are exactly 0 debt maturities occurring in the remainder of the calendar year 2026.
And the weighted average debt maturity is 1.9 years. This calculation multiplies the principal amount of each individual loan by the time remaining until its specific maturity date, sums those time-weighted results, and divides by the total debt of 339.0 million Singapore dollars.
Right.
As of the June 30, 2026 reporting date, the balance sheet displayed net current liabilities of exactly 60.1 million Singapore dollars. The source material states this specific numerical position was caused by a 75.0 million Singapore dollar loan facility that matures in March 2027. Because of that specific maturity date, it was classified as a current liability.
Right. And after the June 30 reporting date, refinancing for this 75.0 million Singapore dollar facility was officially secured.
Okay.
This subsequent action completely resolves the net current liability position and mathematically extends the weighted average debt maturity from the previously stated 1.9 years to a new figure of 2.4 years.
We also have stress testing data regarding the interest coverage ratio. The sensitivity analysis demonstrates that a 10% mathematical drop in EBITDA will cause the interest coverage ratio to fall from 4.2 times down to 3.8 times.
Correct. And a separate variable adjustment, specifically an increase in interest rates of exactly 100 basis points, will cause the interest coverage ratio to fall from 4.2 times down to 3.9 times.
The balance sheet is a static numerical snapshot of a specific day.
Yes.
Because a new refinancing agreement was formally signed after June 30, the March 2027 repayment obligation is replaced by a new maturity date years in the future.
Correct. This post-reporting event legally moves the 75.0 million principal sum back into the non-current liabilities category. Removing 75.0 million from current liabilities instantly eliminates the 60.1 million deficit, returning the current asset to liability ratio to a positive integer.
Right, and simultaneously adding years to the maturity date recalculates the weighted average maturity equation, shifting the total portfolio duration from 1.9 years to 2.4 years.
Right. We evaluate the valuation benchmarking. The distribution yield of the REIT, as previously calculated, is exactly 8.04%.
Right.
We compare this percentage against 3 distinct benchmark rates provided in the July 2026 source material. The first benchmark is the Singapore 10-year government bond yield, abbreviated as SGS.
What?
The yield on this specific risk-free government bond fluctuates between a range of 2.24% and 2.48%.
Okay.
The second benchmark is the Central Provident Fund Special Account Floor Rate, which is a statutory requirement fixed exactly at 4.0%. And the third benchmark is the Central Provident Fund Ordinary Account Floor Rate, which is a statutory requirement fixed exactly at 2.5%. Next, we must examine the portfolio capitalization rates used by the independent property valuers.
Okay.
The capitalization rate, commonly abbreviated as the cap rate, is the expected percentage rate of return that is generated directly by a physical real estate asset, independent of any corporate structuring.
Right. It is calculated by dividing the total net property income of the physical building by the appraised market value of the physical building.
Exactly. And the independent valuers have applied specific capitalization rates ranging from 5.50% to 6.50% to the physical properties held within this total portfolio. We will assess the trading multiples and the specific valuation assumptions. The price-to-net asset value ratio, abbreviated as P/V, is calculated at exactly 0.91 times.
Right. And this ratio is derived by dividing the June 30th, 2026 traded unit price of 0.480 Singapore dollars by the stated book value per unit of 0.53 Singapore dollars.
Yes, the mathematical result of 0.480 divided by the 0.53 is 0.9056, which accurately rounds to 0.91 times.
Which indicates the equity units are trading at a 9% to 11% mathematical discount relative to the stated book value on the balance sheet.
Correct.
We must also state the parameters regarding the rental growth softening. The independent valuers have formally altered the numerical rental growth assumptions used in their property valuation calculations.
Right.
In the previous year of 2025, the assumption variable for rental growth was constrained to a range between 2.90% and 3.00%. In the current reporting period, the new assumption range has been widened downward significantly. The new mathematical parameters for the rental growth assumption are 0.50% to 3.00%.
The sources state that the internalization of the management team completely eliminated specific fees, which lowered the total expense ratio from 1.5% down to 1.08% of net assets.
Right. Subtracting 1.08 from 1.50 equals a 0.42 percentage point reduction in the expense ratio.
Exactly. This structural cost reduction mathematically increased the net income and the resulting 8.04% distribution yield. However, since the expense ratio reduction is a static, one-time mathematical event that cannot be duplicated annually, and the independent valuers have simultaneously lowered the rental growth assumption to 0.50% precisely when 28.2% of the leases expire against 0.7 million square meters of new market supply, we must ask a purely structural question.
Which is?
Does the current 8.04% distribution yield represent a temporary numerical peak generated solely by one-time administrative cost-cutting rather than sustainable, recurring, organic revenue growth?
We thank you for joining this deep dive. We encourage you to review the numbers and perform the mathematical calculations yourself.